To build anything that truly lasts, it takes time.
But to discuss this further and see how the global setup is looking, we are now joined by Peter Cardillo, who's the Chief Market Economist at Spartan Capital Securities, to help us decode the market setup. A very good morning to you, Peter. Now let us start by talking about the US markets first. Now they are at a record high, both the S&P 500 and NASDAQ at record levels. So now, from here on, where do you see the movement? Is the rally going to continue, given we have got a better than expected June jobs report as well? Or do you see, a case for a potential breather, given that that tariff deadline is looming for July 9th?
Yeah, well, to begin with, I think, the market is in the midst of a summer rally, and it's probably going to continue. We had good news with the jobs report, although if you really look at the jobs creation, the government led the pack here in hiring, and so you had 147 non-farm jobs that were created. Half of that was because of government hiring, and so if you take that away, the report really is not as strong as it appears on the surface. Although the total unemployment ticked down to 4.1%. And the good news of the job market was that the hourly wages continued to move up in a very modest way. In fact, they came in better than expected, 0.2%. So basically, it alleviates some fears in terms of perhaps of a contraction in the jobs market, as we saw with the ADP, that is the private sector, that showed that jobs had that the private sector had contracted, and that was mostly due to, of course, fears of the tariffs, and so hiring from the private sector basically was weak. Now, this also takes away the fact that the Fed is not likely to cut in July. And again, even though the inflation news continues to improve and looks good, the fear factor of tariff inflation is still very much on the minds of investors. So this leads us to the next question, and that is, why is the stock market performing well? Well, it's performing well because in a week or so, we'll be heading into second quarter earnings, and we believe that they're going to be strong, and they will be in line with market expectations. So that's the fundamental reason for the market's rally that will probably continue. This summer rally, of course, could take us to higher levels.
Well, all right. So, Peter, that's your take on the entire US market. And of course, today the markets will be closed on account of the 4th of July Independence Day celebrations in the US. But, Peter, give us a sense of what you've made of the bond market in the US lately. Just yesterday, we've seen a little bit of an uptick coming in the 10-year yield. On the flip side, you have dollar index that is absolutely lackluster and not doing anything. On the basis of these two metrics, how do you think the road lies ahead for the US markets?
I'm having difficulty hearing that the last part of the question. I think what you asked me was, now that the tax bill is that is Trump's big beautiful tax bill has been passed and now are waiting for his signature, what will that mean? Well, again, that to a certain degree, in terms of the stock market, it's positive. Obviously, you're going to have lower corporate taxes, and that means that companies will be able to earn more going forward. Of course, there's a negative aspect to that, and that negativity comes from the fact that it's going to add a couple of $1 trillion to a very, very huge deficit. So soaring deficits are not going to diminish; they're going to increase, and so that indicates that we'll probably have a weaker dollar. Dollar probably will continue to weaken, and that means that gold prices are likely to continue to move up strongly.
All right, that's the day coming on the Trump's big beautiful tax bill. But Peter, now let's also talk about some other asset classes. Now, the kind of rally that we are seeing in US markets, June has been a very strong month for the US equity market. Overall, 2025, the first half has been quite strong as well. We recovered from those April lows. But going forward, since that you said that the market looks fundamentally strong given those strong earnings that we are expecting, what's your take on other asset classes? Do you think it's time for one to move their money from other asset classes like gold and shift back to equity?
Yeah, I remain very bullish on gold, and I think, as I said, it's just a matter of time before we hit new record highs. I think somewhere down the line, we're looking at $5,000 for gold prices. That is, of course, not immediately, but I think we're headed for that, and that's based on deficits, and so we just, of course, there's the possibility that the economy strengthens, and of course, there's the possibility that we'll have trade deals that won't have very large implications in terms of inflation. But I don't see that. I think that the trade agreements will bring a certain amount of inflation. So that means that the Fed is not likely to be as generous as perhaps the market would like it to be.
Okay, so that's your take on what the Fed could go ahead, could do going ahead. But Peter, I just want to take that point a little further. Now that this bill has been passed, and you also have on the other side this entire tariff threat that is still upon some countries that have not heard trade deals coming in. Could this tax bill influence the Fed to maybe slightly deviate from the path that it was going to take earlier? Because we're still hearing commentary from Fed presidents, the likes of Raphael Bostic, that are saying that they are still not rushing to give a decision in either direction. Do you think that this tariff pressure could maybe quicken that timeline for the Fed?
I think there's a possibility of that, but we just have to take a wait-and-see attitude and see what develops in the coming weeks and months. But again, there are still major trade deals that have to be agreed upon, and so it's still an open question.
All right. Peter, now I just want to go back to the point you were making earlier about inflation. Now, you have earlier said that, it has been trending lower, it's been improving, but it still remains sticky is what I was reading in one of the reports. So if you could help us understand what are the drivers of the stickiness and what needs to be done now to move away from this point and reach that Fed's target of 2%.
Can you repeat the last part, please?
I was saying about inflation, what do you think needs to be done at the Fed's end to reach that 2% target?
Yeah, I think, we're probably going to hit the Fed target, but not right away. I think now with the budget being passed and with trade deals still having to be sealed, I think that inflation will continue to hover around the present level, which is not bad. It's come down. So that does leave the door open to a rate cut, but perhaps, as I said before, I don't think the Fed is going to be as generous as the market would like it to be, or actually as the administration would like it to be. So yeah, it's just a question of waiting and seeing from the trade agreements and how how inflation will pick up in what certain sectors. Now, there has been some evidence that some of the tax levies are now beginning to show prices that are now beginning to, well, we're now beginning to see prices show up. So far, it's been contained, but the question is, will it stay that way? And my guess is that we're probably going to see a little bit of a bump up in inflation in the months ahead, but nothing that would take us too far away from the Fed target. So it's going to be a while before we hit that 2% Fed target.
Okay, so that 2% Fed inflation target still looking slightly away, but an uptick is what we can expect, not too concerning. On that note, Peter, we'll let you go. Thank you so much for joining us. Always a pleasure interacting with you.
Thank you for having me.
Well, let's move on.